Properly managing your cash is a critical component in growing your net worth, and setting up a solid system will get you months, if not years, closer to financial freedom. There are far better solutions for your cash than a low, or worse yet, zero interest savings account. Don't let your money get away with not working for you. You will be losing serious purchasing power as the effects of inflation compound year after year. In today's video, we will detail a simple path to get you managing your cash like a pro. But first, if you're new to the channel, welcome. My name is Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. Before we dive into the steps, I first would like to say congratulations for having cash to manage. That's a huge step and you're well on your way to financial freedom. But I gotta throw this in. If you have high interest credit card debt, no matter how well you manage your cash, your net worth will be dwindling away. Outside of having a small emergency fund for basic needs and the absolute necessities, step 0 to managing cash is to pay off all high interest credit card debt. Anything double digits and higher must go. And once the credit card debt's paid off, be sure to not put anything else on the credit card unless you can pay it off each month before it ticks interest and you're soaking in some of those rewards. I had to mention it because skipping this step will eat away at your net worth at a devastating clip. All right, let's get into this. We're gonna start with the basics. Let's look at the places that you can store your cash. All right, the first place you can store your cash is a checking account. The second place is a high interest savings account. Third, we have money markets. And then the fourth one is a secret money machine. And this is likely the best option. We'll get into more details at the end of the video. Okay, let's break these down one at a time. And we're going to start with the most basic place to store your cash, and that's your checking account. If you're watching this video, you very likely already have a checking account. This is generally where your paycheck will be directly deposited to each pay period. Now, there are some checking accounts that offer interest. I think I've seen some APYs lately when I checked before doing this video of 1.2%. I think the very highest was 1.5. Usually they're smaller banks or credit unions. And I went down that path years ago to try to maximize every dollar. And I found for me, it wasn't worth it. With a checking account, I value the convenience and the ease of use more than I value making a little extra interest on my money. And missing out on that small APY in a checking account doesn't really move the needle for me because I only keep a balance that allows me to pay my month in, month out bills, have a little bit of extra for emergency, but really I cap it at that. I have a set amount in my checking account. So every month after I pay my mortgage, any dollars above my set amount that I'm comfortable with for paying bills and living life immediately moves into the other options. Whatever checking account you're using probably works for you, and that's great. You don't need to put too much thought into this. The one thing we need to discuss is that really you should only have basically your emergency cash in here, enough to live your life and pay little unexpected bills, but nothing beyond that. So what I would recommend, as I alluded to earlier, is each month when you pay your heaviest bill, usually a house mortgage, but if you, or your rent, it may be something else, but as soon as the biggest bill comes out each month, I would take whatever excess amount is in your checking account and distribute it into the better options that we'll discuss starting right now. The second place we have to store your cash is a high interest savings account. There are several options available for high interest savings accounts. So in order to keep this video more timeless, I'm going to talk about the process of finding the best option as opposed to what the particular options are right now. So what I do is I like to, basically Google best high interest savings accounts, Bankrate. I use bankrate.com. You can also use NerdWallet, but basically just find a list of high interest savings accounts and see what types of APYs they're currently offering. Be sure to read the fine text. Sometimes it's only on the first amount or you need X amount to achieve this APY percentage. So make sure you do your due diligence and read. It's usually pretty basic. And I'm gonna show you the best options right now, just so you can get a snapshot of what you're looking at on bankrate.com. Okay, so I pulled these options from Bankrate in late June of 2023. And as you can see right now, Popular Direct is offering 5.05% on your cash with a minimum balance of $100. And these are all member FDICs, so you're covered for at least $250,000 if the bank goes out of business. So you're safe up to that amount, sometimes more. And then it looks like Tab Bank, 4.76, and then you have a 4.65, and SoFi with a 4.3. So you can shop around right now for anywhere from 4.5% to 5% on a high interest savings account. So as far as my high interest savings accounts, I've used Popular Direct, which was one of the options you just saw in that screenshot. And I've also used Wealthfront, which also offers a high interest savings. Right now, it's at 4.55% at the time of this recording. However, I currently don't have any money in high interest savings. And the reason that's the case is I choose to keep my money in the next option we're going to discuss. Option 3 is money market funds. So instead of keeping my extra cash in high interest savings, I found I get a little better returns in a Vanguard money market fund, and it's ticker VMFXX. And let's dive into the details of this. I've navigated to the Vanguard website and I've pulled up the money market fund VMFXX. This is Vanguard's most conservative, shortest time horizon money market available. The fund invests at least 99.5% of its total assets in cash, US government securities, and/or repurchased agreements that are collateralized solely by US government securities or cash. This fund is based on short-term holdings only. And as I navigate back to the top of the webpage, this 7-day SEC yield this is the percentage that the fund has been producing on a daily basis for the last 7 days. It's the best way to see how much percentage is this fund paying on dollars that I put into this fund right now. And it does include this 0.11% expense ratio. So this expense ratio is already covered and paid, and this is the net amount that comes to you, the 5.05%. The 7-day yield will always be changing. As the Fed has been raising the federal funds rate, it's consistently been going up over the last few months, just like the high interest savings have gone up. There's a high correlation with them. Now, if we navigate down to the distributions, this will show what the fund's been paying on a monthly basis. So for example, in June, which was paid in early July, you received 5.04%. The month before was 5. The month before was 4.76, and so on and so forth. And I will say, for someone who is always looking for high interest savings and money markets and treasury bills to get the best rate with my cash, this fund has consistently been higher than the vast majority, if not all, of the high interest savings that I've found the last few months. Whether you choose to keep your cash in a high interest savings account or a money market fund, the going rate today looks like it's about 4.5% to 5%. And most people believe that the Fed is going to raise the federal funds rate, which sort of controls the flow of all this, another 2 times by the end of 2023. No one knows for sure, but it's fairly safe to say it won't be going down in the next 6 months. And if you have a lot of cash just sitting in a no interest savings account, I want to just take a minute to dive into a spreadsheet that shows just how much that's costing you compared to using these other very simple options. Let's check out a couple different examples here. If you have $10,000 of cash just sitting in a low or no interest savings account, which is extremely common for people, and you're missing out on about 5.05% returns, which is today's rates for that money market and the best high interest savings account, each year you're missing out on $505, which is about $42 a month that money should be making working for you. And if you add a 0 to that, you'd be missing out on $5,000 a year or $421 a month. Let's just say you have $250,000 cash sitting around. This one starts to hurt a little bit. You're missing out on over $1,000 of monthly income. All right, ladies and gentlemen, it's time to reveal that 4th option from the slide earlier, the money-making machine. And that option is the high-quality dividend ETF, SCHD. Okay, so I'm technically bending the rules here. This isn't a typical place to keep your cash. It's technically an investment, but just hear me out. If you're the type of person that has $100,000 or $200,000 of cash just sitting around, but you don't necessarily need it now, say you're still working or you still have incoming cash from different sources, and you're just sitting on that cash long term because you don't want to invest everything, it's always good to have a little bit of safety. This option will take your cash a lot further down the road, and we're going to dive into an example of why that is. But before we dive into that, because it's the last part of the video, I just want to do a real quick review. Everyone should have a checking account that you pay your basic bills out of and sort of that emergency fund flow that we talked about earlier. And then it's probably wise to have a set amount that you're comfortable with in a high interest savings or a money market or a combination of both. There's nothing wrong with that. So this last option with the SCHD, we're really talking about that extra cash that you want working for you long term, but relatively safe compared to your typical investments. Let's take a look now at how SCHD makes your money work for you without being a risky investment like many of the other options available in the stock market. In this scenario, we are taking $200,000 and investing it into SCHD. Now, the day I'm recording this video, the price of SCHD is $72.62 a share. So if we put that $200,000 into SCHD instead of into the high interest savings, we get about 2,754 shares. What we're looking at here is last year in 2022, you would have received $2.56 per share of SCHD that you had that year. And this is what actually happened. We are assuming a 10% compound annual growth rate in the dividend payment. In 2023, we would see 282. In 24, we would see 310, 341, so on and so forth. Each year, the dividend payment we are assuming goes up 10%. And you might think, wow, that seems outrageous. That's way too high. We're gonna jump over to Seeking Alpha right here, and I pulled up SCHD, and I pulled up the dividend scorecard. And as you could see, this is the dividend growth rate, that thing that we're assuming 10%. In the last 3 years, in reality, it's been 12%. Over the last 5 years, it's been 14%. And over the last 10 years, it was 11%. So we're actually assuming less of a dividend growth as the years go by. But the power of this growth rate is that $200,000 that you invest in SCHD without putting another penny into it. So every time dividends are paid, you're taking them and you're spending them, you're living life. So you don't have to invest another penny to have it produce in the first year, $7,700 of income. That's not bad for dividends. But then as the years go by, this is your yearly dividend income from those same exact shares that you never bought any more of. 10 years later, you're at $18,200. And over these, from 2023 to 2032, which is a 10-year stretch, you've received $123,000 of dividend income. And the price appreciation of the stock, so nothing to do with the dividend payments, just what your $200,000 is worth based on the share price. We're gonna assume a 6% growth rate on the price. In reality, it's been about 8% over the last 10 years. So we're gonna try to understate that, if anything, so we don't exaggerate what happens. So the estimated value at the end of each year is going up by 6%. And at the end, you could see in 2032, the same shares without putting another penny in, you got $18,000 of income that year, so over $1,500 a month, and your investment is now worth $358,000. So the price is growing over the years, and your dividend payment, which has nothing to do with price, is also increasing over time. That's the power of a quality ETF that is a collection of a whole bunch of different stocks that consistently increase their dividends regardless of what's going on in the market. All right, it's time to wrap up this video. I hope it gave you some good ideas on how you can manage your cash. I'd really like to thank the 7 people that are still watching for being here. Please hit the like button, subscribe, tell a friend if you're enjoying this content, and help spread the word. And have a wonderful rest of your day, and I will see you here next week. Peace.